All right, so the U.S. stock market's collapsing, coronavirus is spreading across the world, Trump just placed a travel ban on Europe, all NBA games have been canceled, and they even canceled my Baby Shark live concert, which I was so ready to rage out to.
I'm on a rampage, mask on my damn face.
And there's only one thing you need to know to protect yourself in a stock market crash like this.
Hide your kids, hide your wife, and hide your husband because they raping everybody out here.
Alright, that's the last joke. Let's get serious. Today I'm going to be explaining to you how a virus from China can crash the US stock market. And I'm going to be showing you my personal portfolios and how I've only lost about half of what everybody else has been losing. Things you can do to protect your money in long-term investments. For those of you who have Roth or 401ks or retirement plans, I'm going to explain to you what you can do when stuff goes wrong, like it is now. All right, to paint a quick picture, for those of you who might be watching this in the future, today is, what is today? It's actually Friday the 13th. What a coincidence. So yeah, it's March 13th, 2020. Trump just announced there's a travel ban to Europe for 30 days. Pretty much all concerts and major events have been canceled across the US. There has been a ban in the majority of states for gatherings over 250 people. And let's take a look real quick at the coronavirus map. This is an interactive map. I'll put a link in the description if you want to check this out. It just shows you the total cases across the world and the outbreak rates. But yeah, it looks like the majority, almost all people have been recovered. So I've read a lot that the coronavirus isn't that deadly. It's only killing people that are immunocompromised or very old people. If you're a normal, healthy, average person, you're probably going to be fine if you get it. But nevertheless, this still has major catastrophic impacts on the world. And my cat's got the zoomies. Blue, come here. Yeah, gotcha. All right, calm down. Calm down. I know, the world's ending. It should be all right. All right, so to date there has been 1,500 cases in the US, which is very small, but nevertheless, this has catastrophic impacts on our economy. Now, let's take a look at the US stock market. Now, for those of you who don't know, I'm gonna keep this really simple. For those of you who aren't familiar with technical analysis or looking at charts like this, what I have here is the SP 500. This particular chart is the SPY, which is an index that tracks the S&P 500. If you don't know what the S&P 500 is, it's the top 500 companies in the US stock market. So this chart right here is essentially the quick and dirty of how the US stock market is performing. What we're looking at is candlesticks. I'm not gonna explain how to read candlesticks because it's not that important for this video. All you need to know is every bar on this chart, whether it's green or red, is 1 week's worth of price movement. So the bars basically show you which way the stock's moving over a week period. So if you look down at the bottom, you can see that we're actually looking back all the way to 2017. This big dip here, December 8th of 2018. If you remember, last year we had this major pullback and it took almost half the year to almost an entire year to recover from it. And then we start moving up. Now, the yellow line you see at the bottom here, this is the 200 SMA. It's a simple move average, and what it does is essentially looks back the past 200 bars and gives you an average of what that price is. It's a very important indicator. It's a very strong indicator. It is probably the most used indicator in the world. I know all major institutions that move billions and billions of dollars, they all use the 200 SMA. Now, if we zoom in, you'll notice that the stocks started to fall actually 3 weeks ago. So we're just now getting travel bans and people are freaking out and thinking the world's gonna end. However, the stock has been crashing for the past 2 to 3 weeks. And if you remember this, people were kind of freaked out a little bit.
Oh my God.
Not as much as they are now. So how does a virus from China affect the US stock market in such a massive way? And just to show you how much it has influenced the US stock market, I can measure this, and the bottom of the charts right now, negative 27%, 27% loss in 3 weeks. That's pretty significant. Currently, the price is about 23%. So as of right now, Friday the 13th of March, at 3:44 p.m., we are down 23%. which is still quite a big move. So if you really want to understand how a stock market moves, any stock market, it doesn't matter what market it is, I highly suggest you study what was called in history the TULIP bubble. So in the 1700s, one of the first stock markets that ever existed was in the Netherlands, and essentially they were trading tulip bulbs. And at one point, you could buy a single bulb of a tulip for $1,300 in today's money. Imagine going to a florist and spending $1,300, not on the flower, not on the bloomed flower, the actual bulb itself. And keep in mind, this was back when they didn't have cameras or photography. You had no idea what the hell you're buying. You just bought a bulb and you hoped that it would be worth $1,300 6 months to a year from now when you plant it and actually harvest it. Needless to say, this was a bubble and it collapsed. There's a really good show on Curiosity Streams, and there'll be a link in the description if you want to check out Curiosity Streams, called The Tulip Bubble. Highly recommend you watch it. There's also a few others, the 1929. There's anything that has to do with a bubble, I highly suggest you study it. But the underlying factor here, and the one thing I want to get across is, today we think about the stock market as numbers and mathematics and super smart people with all kinds of charts and computers and calculations and stuff. The reality is, the stock market is entirely people. The stock market only moves because people believe in something. And in this case, people are afraid. They're fear. Fear is what is causing a stock market to move.
She weighs the same as a duck. She's made of wood.
And therefore...
A witch! A witch!
I want you to imagine that there's 10,000 people in a room, and they're all arguing over what the price of something is. Now, in normal times, when nobody's panicking, people just kind of argue back and forth and they trade and the stock just goes up and down. However, if you were to take a box of rattlesnakes and chuck them into the room of these 10,000 people, there's going to be massive panic and probably a stampede, and everybody's going to be trading get out of that room as fast as possible. And when people panic, they do really dumb stuff with their money. So what's happening right now is people are pulling out all of their money and trying to move it or protect it and safeguard it. And this is a very amateur thing to do, but it's the most baseline instinct that people do when they get scared. They want to protect what they have. It's understandable. It's just not the smart thing to do. What you should take away from this video is anytime you're looking at overall markets, big picture stuff, bull runs that run for 10 years, the biggest factor you should pay attention to is fear. Watch the masses. Don't do what the masses do. I highly recommend you don't do what everyone is doing, but pay attention to what they're doing and pay attention to how afraid they are, because the more afraid people are, the harder stocks are going to fall. Now, real quick, I'm just going to give my personal opinion on this. This is a very big and fast move, but it's not unhealthy. I don't see this as a major catastrophic drop. Everybody's talking about this being the start of the recession or the start of the collapse. It may be. I'm not going to try to predict the future. And anybody that says they can predict it is bullshit. They're lying to you. Nobody knows what's going to happen in the next few weeks of the stock market. It might bounce and just continue going long. But as of right now, it looks healthy to me. So back to this yellow line here that I have, the 200 SMA. It's a very important line. So far, the stock is holding up on the 200 SMA. And that's the major indicator, at least for me, that indicates that we are still in a bull run. We have just had a massive pullback. And if you notice this white line right here, this is my previous trend line. So I actually drew this line maybe, 4 months ago, and I just leave it on my chart. And this is basically touching the top 3 highs of the past, almost year, all the way back to January of 2018. And you'll notice that the SP 500 broke out of this line and it overextended. Now, typically, if this was a regular stock, pattern would be called a bear trap or a bull. This specific one is a bull trap. However, because it's the S&P 500 and people started to pile into the S&P 500 because they thought it was going long, going to the moon is what everybody thinks. That's the amateur way of investing or trading. My personal opinion is you never should try to buy into stuff when it's at all-time highs, because it's the most expensive it is. When people are afraid, markets crash. When people are confident, markets move up. But you don't want to do what they do. You want to preemptively move your money in ways and protect your money in ways that counteract the moves of the masses, which I'll explain in a minute. So let's look at my 2 portfolios. I've got a Roth IRA and a personal portfolio that I've been building. and I'm only losing about half of what everybody else has been losing. So what we're looking at, this is M1 Finance. This is my personal long-term portfolio investment. This is not day trading. This is not any kind of trading. This is like buy and hold long-term for the rest of my life strategy. If you would like to check out M1 Finance, there'll be a link in the description below. You can sign up and get 10 free dollars, and I get 10 free dollars. It helps the channel. Real quick, I'm gonna do some math. So I'm gonna take the highs of my personal portfolio, which is 3,064.44, minus the low. Minus 2811.60, $552. Divide that by the high. So that's a loss of 16%. So my portfolio only lost about half of what the overall stock market lost, 26%. Almost. I'm off by 2 points. Let's take a look at my Roth IRA real quick. So I had a high of 9,070.95 minus 7,203.16 gives us $1,800 loss divided by the 970.95, 20% loss. So my Roth doesn't perform quite as well as my regular portfolio, but that's because I use indexes instead of individual companies. I'm gonna explain to you how I only lost almost half of what everybody else is losing, and that's due to what's called hedges. So hedges are ways you protect your money in case of downturn. So there's a lot of different ways you can hedge. There's actually a ton of different ways you can hedge, but the most popular ones are US bonds, which usually perform very well during recessions, precious metals, and then late cycle or recession-proof companies such as non-consumer staples, telecommunication, and utilities. So anything that people use, no matter how bad the economy is going to be a type of hedge that protects you on the downside turns. And also anything that's non-US. So we as Americans often look at the US stock market as the stock market, but there's stock markets everywhere. There's a Hong Kong stock market, there's a European stock market, there's a Chinese stock market, there's a Brazilian stock market. So in every market, every country is going through its own cycles. So while the US stock market might be really high, the Brazilian stock market might be really low. And when the US stock market crashes, Chinese stock market might be going long. So by moving your money from one market to another, you can better protect your money through hedges. And this is all hedging. Now I will note that there's one interesting thing here. So gaming has only lost 9%, whereas real estate has lost 28%. Non-US hedges has lost 23%. Precious metals is down 13%. Bonds is actually up 1%. So again, bonds are very good. But you'll notice, you can look here and you can see what sectors have done the worst. Finance is down 32%, tech is down 23%, industrials is 26%, and energy is down 45%. But however, you'll see on the right side here, these are where all my money is allocated. And the majority of my money is in precious metals and bonds and non-US hedges. Bonds have done really well. Utilities has been hit kind of hard, but that's understandable. Consumers is 19%. And then surprisingly, way down at the bottom, gaming, which is only 2% of my portfolio, unfortunately, has only been down 9%. And it kind of makes sense. So when you just think about what people spend their money on during a recession, and in this case, this isn't a recession, this is a virus outbreak, everybody's staying at home. Everybody's chilling at home, not doing anything. They're not going out. They're not going to be spending money. So what are they going to do? Especially if they're guys, probably going to buy a video game. And in this case, the only two holdings I have is NVIDIA, which is actually a chip company. They make graphics cards and stuff. But my other holding, which is 40% of my gaming, is Activision and Blizzard. And if you know anything about gaming, Call of Duty, the new Battle Royale game came out.
Confirmed.
Go, go, go!
Yes, yes!
So everybody's probably going to be playing that and buying that game. So Activision, if we go back over to their charts, this chart looks way better than the US stock market. It's only gone down over the past 3 or 4 weeks, 18%, and it's currently holding at 11%. So hopefully that paints a decent picture so you can understand how sectors and industries move based on what's happening, and you just have to think through what's going to happen. Unfortunately, if you're watching this video and you're expecting me to show you how to, magically take your money and save all the money that you've lost if you're down 25%, I can't do that for you. In order to protect your money, you have to preemptively do things to protect it. So if I open up my consumer defensive or my consumer sector, I have consumer defensive and consumer cyclical. There's different types of consumer products. Consumer stuff is toilet paper and food and groceries and stuff like that. If I open up my defensive, we've got Pepsi, Target, Estee Lauder, Walgreens, Costco's, Nike, Coca-Cola. Nike's not really consumer staple, but they're a very solid company, so I consider them defensive. But if you look, Costco is only down 7%, Coca-Cola 17, Walgreens is 15, Target is 13. These are all companies that people are going to go to even during recessions. They're going to be spending money there to buy the essential things that they need to live. If we go to consumer cyclical, we got things like, again, Coca-Cola, Disney, Home Depot, Texas Roadhouse, and then I've got a small section of marijuana, which marijuana is down 36% because, again, it's cyclical. People aren't going to be buying weed, and also the weed sector is very volatile right now, so that's not really an accurate representation, but these are things that people don't need necessarily to survive. So what do you do to protect your money in this situation? The reason I set up my portfolio the way I did is because we are 10 years deep in a bull run, and let's take a look at this chart. This chart is a very useful chart to have. I actually look at this chart more for long term than I do any individual price chart. This is the SP 500 PE ratio. PE ratio is price to earnings. It's basically a ratio that shows price of a stock versus the overall earnings in the US stock market. And in this case, we're talking about the SP 500. So it shows the overall earnings over all the companies. The reason this chart is really useful is because it's a ratio. Because it's a ratio, it always fluctuates in a certain range, and because it's uniform, you can look at it and you can see that everything is kind of, between 25 to 10, and it goes all the way back to the 1800s. If I go over to my price chart, let's go to the S&P 500 again, scroll all the way back. I think it only goes to 94. If you were to just look at this chart, even with the 200 SMA, you can kind of gauge what's underpriced and overpriced, but it's much harder than looking at this chart. So how do you use this chart? Typically, anything between 15 to 20% is an average price for stocks. Anything over 20% is considered overbought or too expensive, and anything under 15% is very inexpensive. Right now, as of today, this chart was updated. Let me update it. It was updated at 4 p.m. today. Current PE ratio is 20%, which is still very high. So even though, the price on the chart has dropped a lot, and we've dropped 30%, and we can see that it's still bouncing off the 200 SMA. Now, if the price was way down here in this area, that would be a very big fall. And the PE ratio would probably be down to 16% or so. So by using this chart, you can better gauge if the overall market is overbought or oversold. And actually, every company, every sector has its own PE ratio, and you can pull up charts for that at any time. So for me personally, my plan of action is to pump as much money as I can into the S&P 500 right now, into my portfolio, because stocks are super cheap. Everything's bottom dollar right now. Well, not bottom dollar, but it's cheaper than average. So the amateur investor will buy here, whereas professional investors will buy down here. And then people that have a lot of money and are holding cash back, they will hopefully wait for the stock to drop down here, and they'll buy stuff bottom dollar. Now, down here, this is a recession area. This is where the economy is really bad and stuff's going terribly wrong. Let's say, what do you do in this area? What's the plan of action before a big crash? For me, I get super defensive. I think my portfolio is hedged maybe 40% to 50%. I can't remember exactly. I'd have to count it up. We're 10 years deep into a recession, so you want to move your money into things that are very defensive. There is a downside to that. Let's say the US stock market continues another 5 years into the bull run. The returns might not be as good. You always have to gauge what you are looking for. Do you want to protect your money more, or do you want to make more money on the upside, depending? And this also factors in your life situation. It's really hard to make a YouTube video explaining what somebody would do in a certain situation, because there's tens if not hundreds of thousands of you watching this video right now. You're all different ages, you all have different lives. Some of you have kids, some of you have wives, some of you are 50 years old, some of you are 18 years old. So the general gist is, the younger you are, the more aggressive you want to be. The older you are, the more defensive you want to be. Moving forward, What I'm going to be doing is dumping as much cash as I can into my portfolio because stuff is very cheap. And there's a secondary option. This button right here called rebalancing. What I can do, I could go in here and I could edit my percentages. So because bonds have been performing so well and holding their value, I could actually reduce bonds to 10% and then take that 8% that I have and move it into sectors that have been beaten down really hard, but I think are gonna go up over the recovery. So if you wanna visualize it, you've got aggressive stocks and defensive stocks. When markets crash, defensive stocks usually hold or maybe go up a little bit while aggressive stocks crash. Aggressive stocks are things like tech companies, anything that's very highly leveraged or just very volatile will crash. But because your money is protected through the hedges, and this has crashed, so even though it's crashed, it's become cheaper. As long as you're buying into companies that are solid, that you understand and believe are good companies that will weather and survive the recession or the crash, you take the money that you've protected and you move it into the cheaper stocks because they're gonna rebound and come up, which will gain you more money. So you have to visualize shifting your money from defensive to aggressive based on what the overall market is doing. And this is the basics of hedging. I hope this explains to you how a virus, China, can help crash a stock market that is 5,000 miles away. It's entirely driven by people. We use numbers and we use charts and we use analytics and all kinds of stuff to help explain and visualize what's going on, but none of that stuff has anything to do with the markets moving. Markets move because people get afraid and people get fearful. And the amateur investors, when they get scared, they pull out money because they feel like they're going to protect themselves. A lot of times that's not what happens because there's all kinds of factors like slippage. There's a whole bunch of things that can really burn you when doing that. The things to do is to understand the stock market and how it moves and how it works before it happens and anticipate it happening, because every market crashes. I've got a friend who's an iron worker and he has been hitting me up every week, and there's a guy I know that's in real estate from San Francisco who's been hitting me up every week for the past 3 weeks, freaking out about the stock market crash. I'm chilling. It's not anything new to me. It's not anything I'm afraid of because I expect it. I expected the stock market to crash before that ever happened. Now, I'm not saying I predicted the stock market crash. I'm not predicting the stock market crash. Nobody can predict it. I'm saying is when you understand how markets move, you know that they're going to crash. They always crash. There's always going to be a crash. What you need to understand is, are we overextended or underextended? Is prices too high or are prices too low? And it's very simple to see that. If you look at the chart, this is overpriced. Like, this is highest highs and we're breaking out of this trend line. So if you scroll back here, if we just draw an overall trend line, you can look at the trend line of a stock, and essentially it's the rate of ascent that the stock is going. So if the stock averages a rate like this, and then all of a sudden it starts to go like this, it's overextending itself, moving at a rate that it can't possibly sustain itself off of indefinitely. So it's inevitable it's going to crash, and that's exactly what it looked like. Like this, look at the difference in this angle here. You can't survive. You can't sustain that rate of growth for very long. It's going to come down. The U.S. stock market crashing was a combination of the fear of the coronavirus, and it was also just a technical pullback. It had to come down because it was increasing at a rate that it couldn't sustain. And on top of that, you can look at the PE ratios here. I believe before the crash, we were up to 25%, which if you look back in the history, it's only touched 25% a few times. Now, in the 2008, we've got this massive spike, which was caused by insolvency and a whole bunch of other things I'm not going to get into. Just by looking at these two charts, it's not surprising to me that we had a crash, that we're down here now. Now, obviously, the coronavirus has amplified this crash, but it's not anything that is surprising to me personally. All right. For all you loyal followers who have watched all the way to the end, I'm going to give you one more piece of information at the end of this video. It's the #1 indicator that I actually pay attention to other than what I've already shown you. There's one thing I forgot to mention. Earlier I said hitting that rebalance button on M1 Finance. I forgot to mention that if you do that and you've made profit on any of the stocks you've sold, you're gonna be paying taxes on the profit. However, if you're at a loss, you can actually write off those losses on your taxes. There's actually a thing that a lot of stockbrokers do where at the end of the year, if they have any losses, they'll sell that loss at like December 27th, and then they'll just re-enter the position in January, which will allow them to write off that loss on their taxes, but they still stay in their position. They're just off for like a day or two. If you would like to learn more about the psychology of people and how they influence stock markets, I cannot recommend the book Market Mind Games enough. It's a fantastic read for entry-level people that are trying to learn more about the stock market, as well as The Big Debt Crisis by Ray Dalio. It's a bit more complicated of a read. It's over macroeconomics and market cycles. I don't know if I'd necessarily recommend it as a first-time read for the stock market, but it's fantastic when trying to understand and learn the macroeconomics and how markets move through cycles and how governments can influence markets. And if you guys have any questions about this, feel free to message me on Instagram. I'm going to start making more content on there, as well as if you have questions, I'll just answer them on my story. It's a lot faster than trying to make a YouTube video. And I know all of you have been waiting a long time for videos. The next video that's going to be coming out is what happens if you read 50 books on money. I'm trying to get it edited and done this week. I've actually hired an editor. I've already put like 60 to 80 hours in this thing. I'm ready to get it done and get it out. And upcoming videos will be how I rented out my house for profit, how I'm going to be traveling cheap across the US for the next 3 months to maybe a year. And finally, my #1 secret indicator that only you people who have watched to the end will see is...
And his name is John C.
Got him! Got him!